Good afternoon, subscribers and viewers. Wanted to talk about a pretty funny article posted this morning by Tyler Durden on ZeroHedge.com. Um, Reader threatens to sue Fed after losses incurred by going long inverse leveraged ETFs. And he goes in here. At first, I thought this was a joke. I don't know if you guys know what these ETFs, these leveraged ETFs are, but they're one of the biggest scams to come down the pike that Wall Street has foisted off onto the public. Anyway, this guy says that basically he's arguing that since the Fed came in and bailed out the banks, and he was short the banks via one of these inverse leveraged ETFs, that he has a case against the Fed, and it's pretty funny. Anyway, it reminded me because I spent some time myself playing around with some of these. I think I did SRS at one point and FAS at one point, and so in the process of losing some money on these things, I did a little bit of research and figured out how they work. One of the things you find out about these is that they have a decay on them, and they don't. You would think that. Well, let's pick up one here. You would think that if the stock market is down 50%, then the leveraged short one would be up the same amount. And this one here, basically what I've done here is to get a cross of these. It's the UYG and the SKF. You can look them up yourselves. They're all available on Yahoo. And as you can see here, this is inverse ProShare Ultra Financials long and short. So you can see here, we've got today's activity over here. This is a 5-day. And you can see we're about up 6% on the long one. And then we're down about 6% on the short one. So you can see they look to be mirror images of each other. And that's what you'd think, right? These are going to trade as mirror images. If one's up 6%, one's going to be down 6%. But an interesting thing emerges as you begin to scroll out on the time scale. So we're currently looking at the 5-day. Let's jump out to the 1 month. Okay, so we see on our 1 month, this is kind of an anomaly for these. You don't usually see this. You can see we're up almost 20% on the long, and we're down about 16-17% on the short. So that there's a little bit of discrepancy, but they're still mirroring each other. Now let's go out a little bit more to the 3 month, and we're still pretty good at the 3 month. Down 20%, up 20%. Let's go out to the 6 month. Now we got the 6 month. You can see that the long is up 20%, but the short's down 25%. Interesting. And you go out a little bit further to the 1 year. Now we've got the longs up only about 15%, while the short is down all the way down 35%. Take it out a little bit farther, the 2 year, and something really interesting emerges. Now we see that the long is only up about, that looks to be about 25%, but the short is down a good, what is that, 60, 70, 80%? So let's go out one more to the 5 year. Something really interesting happens now. You can see that the SKF on the 5 year is down, what, 60, 70%? And the UYG is down, look at that, 70, 80%. How can these both be down? Isn't one long and one short? Aren't they supposed to be mirror images? We saw it in the short term here, right? They are. But then over time, it seems to not hold. And there's your max. So that's the UYG and the SKF. Now we've also got the FAS and FAZ. You probably heard of those. Those are ultra short and ultra long financials. We'll look to see if we get the same pattern, 30 and 25. Okay. Now it's beginning to diverge and out to the 2-year. And that's really ugly on the FAZ, which that's people who were shorting banks, right? You go along the FAZ. No, you probably would have been better off shorting the banks. Let's go out to 5-year, and you can see the FAS is at 0, and the FAZ is just off the charts. And then to the max. So if you were long the banks, you were down 20%. And if you were short the banks, you're down like 99%. So that's the FAS and the FAZ. And we got one more here. This is the URE and the SRS. SRS is ultra short real estate. URE is ultra long real estate. And let's check our patterns here. Our 1 month, 3 month, 6 month, 1 year, 2 year. And that 2 year's holding up pretty good, the long real estate. Let's go to 5-year. Oh, look at that. So real estate collapsed, right? Here's your URE. Collapsing about the time of the, let's see, financial crisis. And you have this big boost here. Big old boost to the short real estate, but then it just gives it all right back, and here we are. Let's get to the max here, and one's down about 70%, the other's down 80-90%. So another fantastic scam brought to you by Wall Street. I think it was Jesse Livermore or somebody said that there's one goal of the stock market, and that is the transfer of wealth from Main Street to Wall Street. Well, here you go. So just like our gentleman who invested in the ETFs because he thought he was going to, be smart and short the financials. No, that doesn't work that way. So now I wanted to point out a little strategy. So you can see here that each one of these is a big old scam. Now the question is, if that's so consistent that they both go down, can't you short them both? Isn't that the perfect hedge? Couldn't I take a dollar amount of UYG and the same dollar amount of SKS and just short them? Isn't that easy money? Certain money. They're both going to decay. They trade in opposites in the short term, so it's a hedge. So today, I'd be up 6% in one and down 6% in the other, as long as it's an equal dollar amount. I guess you'd have to adjust them over time. But anyway, maybe there's an idea of how we can beat Wall Street at their own game. Somehow, I don't think so, because they tend to be real crooks. So they'll probably find a way to either cheat or change the rules. But so there's your leveraged ETFs, and wow, what a scam. Talk to you next time.